Jim Simons and Renaissance Technologies, the Medallion Fund story.
Yes, they got very rich.
Very, very smart.
And very smart and very rich, yeah. And very high grade, by the way.
Yeah.
Jim Simons.
But we're not trying to make money trading stocks. I mean,
no.
The answer, we don't think we know how to do it. I mean, it isn't. If we knew how to make a lot more money trading stocks, we'd probably be trading stocks too. But we don't know how to do it, and we really don't trust anybody else to do it for us. That's simple.
This is the story of the most legendary trader who ever lived, and with an investment ethos that will leave you shocked. Jim Simons didn't just beat the market, he left every other legendary investor in the dust. While most of Wall Street celebrates 15% annual returns, Simons' Medallion Fund averaged 66% per year before fees, every single year from 1988 to 2018. That's not just good. That's mathematically absurd compared to what even the best of the best have achieved. Jim Simons built the most successful hedge fund in history. How Renaissance Technologies stacks up against the greats? Jim Simons. 66% gross / approximately 39% net. Quantum Fund, George Soros, approximately 30%. Duquesne Capital, Stanley Druckenmiller, 30%. Tiger Fund, Julian Robertson, approximately 25%. Berkshire Hathaway, Warren Buffett, 20%. S&P 500, approximately 10%. Medallion didn't just edge out the competition. It doubled Soros, tripled Buffett, and crushed the S&P sixfold. And it never had a losing year. So who is Jim Simons? Jim Simons wasn't a banker or a Wall Street trader. He was a brilliant mathematician, code breaker, and academic. Born in Brookline, Massachusetts in 1938, he earned his PhD in mathematics at just 23, taught at MIT and Harvard, and worked for the U.S. National Security Agency breaking codes. In the 1970s, he co-founded a floor tile and piping business. When they sold part of the company, Simons made a sizable profit. That money sparked an interest in investing. The radical idea. In 1978, at 40, Simons left academia to form Monometrics, later renamed Renaissance Technologies. At first, he traded like everyone else, gut feeling, market news, and intuition, and he hated it. Simons asked himself a radical question for the time. Could mathematics, vast data sets, and the scientific method be applied to consistently beat the market?
Proving it. We have about 100 PhDs working for the firm.
That's what I mean. How did you get to that point? Did you start to think, we need this, we need that?
We just hired smart people. My algorithm has always been, you get smart people together.
Instead of hiring seasoned traders from Wall Street, he deliberately recruited mathematicians, physicists, cryptographers, and other scientists. People skilled at solving complex, abstract problems. These recruits weren't reading company reports or watching CNBC. They were writing algorithms, crunching decades of historical market data, and applying advanced statistical techniques. They began building models to identify patterns and anomalies in prices, correlations, and behaviors that no human eye or gut instinct could reliably detect, aiming to turn market prediction into a repeatable, data-driven process. But how did they do it? What were their systems? Let's dive into their secret sauce, inside the Medallion machine. If you enjoyed this deep dive and want more stories that break down the strategies of history's greatest traders, make sure to like this video, subscribe to Traders Lab, and hit the bell so you never miss the next lesson. Time to dig in and get inside the Medallion machine.
You might guess, oh, such and such should be predictive, might be predictive, and you test it out in the computer, and maybe it isn't, maybe it isn't. You test it out on long-term historical data and price data and other things. And then you add to the system this if it works, and if it doesn't, you throw it out.
System 1, mean reversion. This strategy looks for situations where a price has moved too far away from its average. The models calculate a rolling mean over different time frames. And when the deviation is statistically significant, it triggers a potential trade. Example, if oil typically trades around $70 a barrel but drops to $60 within a few days, the system might buy expecting a snapback to the mean. If it spikes to $80 during a seasonal demand surge, they might short, anticipating a fall once the short-term imbalance normalizes. Another example, if a currency pair like EUR/USD has an established 90-day average near 1.10 and suddenly falls to 1.06 on low-impact news, the models may see it as an overreaction, take a long position, and exit as it reverts toward its statistical norm. System 2. Trend following. Here, the algorithms identify short-term momentum and aim to ride it before it fades. They measure directional movement, volume confirmation, and time-based persistence of a trend. Example: if gold has risen steadily for a week with strong volume, the system might go long to capture the final stretch of the move, exiting when reversal signals appear. System 3. Statistical arbitrage. This involves scanning thousands of related assets to find small, temporary misalignments. The system uses correlation and cointegration tests to spot when two assets that usually move together diverge abnormally. Example: if two airline stocks normally move in sync but one drops sharply due to a temporary overreaction, Medallion might buy the laggard and short the leader, profiting when prices converge. Example 2. Crude oil prices and oil tanker shipping rates often trend together due to shared demand drivers. If crude oil spikes while tanker rates lag without a fundamental reason, the system might long tanker stocks and short crude futures, expecting the relationship to converge.
As it is today, is extraordinarily elaborate. But it's not a whole lot of, it's what's called machine learning.
System 4. Machine learning. Renaissance was decades ahead in applying advanced algorithms capable of uncovering non-linear, hidden patterns buried within enormous datasets. This initiative was spearheaded by hires like Peter Brown and Robert Mercer, who came from IBM's natural language processing division with no finance background, but deep expertise in pattern recognition. They built and refined black box models that ingested thousands of variables, everything from macroeconomic indicators and interest rate shifts to satellite weather imagery and shipping traffic, and then tested millions of combinations to find statistically significant relationships. These models could detect subtle, predictive signals that human traders would never see. They were constantly trained and retrained on fresh data, learning which signals persisted and which decayed. Example: the system might discover that a sequence of milder than average winters in the Northern Hemisphere consistently led to reduced natural gas demand, which in turn pressured energy futures prices. Once validated, that insight would be coded into the trading engine, automatically generating position signals and controlling trade size according to confidence levels, with zero human override.
For one thing, commodities especially used to trend. Not dramatically trend, but trend. So if you could get the trend right, you'd bet on the trend, and you'd make money more often than you wouldn't, whether it was going down or going up. That was an anomaly in the data, but gradually we found more and more and more and more anomalies.
System 5. Risk sizing via Kelly criterion. At the heart of Medallion's discipline was the Kelly formula, a mathematical framework for calculating the exact fraction of capital to risk on each trade. It works by combining two key inputs: the probability of a trade's success, win rate, and the payoff ratio, average win versus average loss. The formula is Kelly percent equals open parenthesis BP minus Q close parenthesis divided by B, where B is the ratio of average win to average loss, P is the probability of winning, and Q is the probability of losing, 1 minus P. If a model projected a high confidence signal with a strong payoff, position sizes would be increased. If confidence or payoff was low, the system would scale the risk down. This meant that no single position could ever sink the fund, while maximum capital was reserved for the most statistically favorable trades. These rules-based allocations were updated dynamically and consistently, cutting human emotion out entirely and ensuring growth was optimized, while drawdowns were tightly controlled. The beauty of Medallion wasn't one magic formula. It was thousands of tiny, rigorously tested edges, traded again and again, like a casino with a slight but unrelenting house advantage. They were already leading the market, but next came the crisis test. In August 2007, a quant quake shook Wall Street to its core. A sudden, violent unwinding of highly leveraged quantitative positions across the industry. Correlations between assets broke down, models that had worked for years failed overnight, and many elite quant funds saw losses exceeding 30% in a matter of days. Medallion wasn't spared from the initial chaos, dropping 20% almost instantly as liquidity evaporated and spreads blew out. For most funds, this was a trigger to slash positions, override their carefully built systems, and go into capital preservation mode. Portfolio managers stepped in manually, selling positions at the worst possible time in an attempt to stop the bleeding. Others panicked even further, dumping assets at fire sale prices and locking in devastating losses. Simon's team didn't flinch. No overrides, no emotion. They trusted their models completely, continuing to execute trades exactly as the algorithms dictated. While other funds were abandoning positions, overriding signals, and second-guessing their strategies, Renaissance moved with precision, methodically adjusting positions only when the live data and their systems demanded it. This wasn't passive inaction, it was disciplined, rules-based execution in its purest form, with every trade size, entry, and exit still governed by the same rigorous models. That unshakable commitment to process allowed them to not just recover their August losses, but to close the year with a staggering plus 85.9% net, while many peers finished deep in the red. For context, Berkshire Hathaway returned roughly 28% that year, an impressive figure by most standards. Yet it still paled in comparison to Medallion's performance during one of the most turbulent market periods in modern history. Why others couldn't copy them? Renaissance technologies built an almost impenetrable moat. They had decades of meticulously cleaned and structured data, including obscure alternative data sources like shipping logs, satellite images, and even weather reports, giving them signals competitors couldn't see.
The prediction part, but the prediction part is not the only part. You have to know what your costs are when you trade. You're going to move the market when you trade. Now, the average person will buy 200 shares of something, and he's not going to move the market at all because it's too small. But if you want to buy 200,000 shares, you're going to push the price. How much are you going to push the price? How are you going to, are you going to push it so far that you can't make any money because you've distorted things so much? So you have to understand costs, and that's something that's important. And then you have to understand how to minimize the volatility of the whole assembly of positions that you have, and be so you have to do that. That last part takes some fairly sophisticated applied mathematics.
Their computing infrastructure was cutting edge long before Wall Street embraced it, enabling them to crunch terabytes of information and test ideas at lightning speed. They mastered execution, slicing orders into thousands of tiny trades to hide their activity and minimize slippage. And every model was built with strict trade size controls based on statistical confidence. The firm's culture was equally unique: a closed shop with no outside investors, total secrecy, and complete loyalty from a hand-picked team of scientists who shared research openly inside, but never let it leave the building.
We're very universal. We don't have any, but it's a big computer model. For one thing, there is a capacity to the major model. It can manage a certain amount of money, which is rather large, but it can't manage an enormous amount of money because you're going to end up pushing the market around too much. So it was kind of a sweet spot as to how much it's reasonable to manage.
By the time rivals spotted one of Renaissance's profitable patterns, the team had already moved on to the next, always adapting, always 2 steps ahead. Imagine putting $1,000 into the Medallion Fund in 1988. By 2018, that small stake could have grown to over $40 million, even after fees. The same $1,000 in the S&P 500, roughly $10,000. That's the staggering impact of compounding at 39% net per year versus 10%. Year after year, without a single losing year, those gains stacked higher, creating an almost exponential curve. And in the worst years for markets, like 2000 and 2008, when others lost half their capital, Medallion delivered positive triple-digit or near triple-digit returns, accelerating that compounding even more. This wasn't luck. It was the mathematical inevitability of a small but consistent edge applied relentlessly over decades. Trader takeaways, lessons from Simon's: trade like a scientist, base decisions on data, testing, and measurable probabilities. Treat every idea as a hypothesis to be proved or disproved. Small edges win big. You don't need to be right all the time. Even a 51% edge compounds massively if applied consistently. Build rules and follow them. Design systems with clear entry-exit triggers and strict disqualifiers. Let rules, not emotions, decide. Risk control is non-negotiable. Use formulas like the Kelly criterion to size trades according to statistical confidence, limiting losses, and maximizing long-term growth. Cut emotion. Out 100%. Automate decisions where possible to remove fear, greed, and hesitation from execution. Think in probabilities. Focus on the outcome of many trades, not the result of any single one. Play the long game. Simons was 50 before cracking the code. Patience and persistence are as vital as the strategy itself. Jim Simons proved that with the right mindset, the right tools, and relentless discipline, you can turn trading into a science and science into fortune. Persistence has a lot of value. Whether you're a quant or a chartist, remember, the market rewards those who think in edges, not certainties. If you enjoyed this deep dive and want more stories that break down the strategies of history's greatest traders, make sure to like this video, subscribe to Traders Lab, and hit the bell so you never miss the next lesson.